Hi everyone. Ας ξεκινήσουμε. Καλώς ήρθατε. Welcome to our Tech Finance Network meetup. Today we're hosting Zepos and Yiannopoulos firm once more. We had a very useful event with them, which is actually posted online on YouTube on ESOP tax. And today we're going to do a deep dive on tax, on all aspects from ESOP to angel investing, to employees in general, benefits, bonus, etc. And they're going to be here to answer all our questions after their online presentation for the physical meetup. Thank you to Welcome Pickups for hosting this meetup today. And I'm just going to already give it up to Elena from Zepos and Yiannopoulos, and she's going to take us through tax for ESOP.
So thank you. Thank you for having us here today. And thank you, Thalia, for putting this together, and Elena for hosting the event. Welcome Pickups. Very brief introduction, although I see a lot of familiar faces in the group. Both Elena and myself are tax advisors with a legal background, and that's another way of saying lawyers. We're both members of the Greek law firm Zepos and Yiannopoulos, or Zeia in short. Zeia is a business law firm working a lot on transactions, quite exposed in the startup ecosystem. Today, it's all about tax, as you can see from the presentation. So I'll just give you an overview of, okay, so how does this work like this? No? Okay. So what we thought of doing is structuring our discussion under 3 sections, switching from audience to audience. So section 1 is addressed mostly to employees or executives. So it's all about tax efficiency on compensation. Second section is mostly addressed to founders. So it's mostly about capital gains, dividends, structuring a business operation in Greece. And third section is the shortest one, just addressing the tax incentives that are still available in Greece for angel investors. We will go through the whole thing, as Thalia said, and then take questions for all 3 sections at the end. And it goes without saying, if you feel that we're not addressing all issues that are of relevance, just feel free to add any questions that are trending, just not on banking. Okay, thank you. Okay, so first section, employees. Obviously, we will go through stock options. We have a few examples here. Before I give the floor to Elena, what we thought of doing is, instead of guiding you through the rules on how stock options are treated for the employee, depending on a number of events, which is a bit complicated, we will structure it through an example. So we will have a baseline scenario and then see a few different alternatives on that baseline. The baseline is stock option program that is offered to Greek tax resident employees employed by the Greek subsidiary of the foreign, wherever in the world that is. Let's assume holding company. It could be an affiliate or anyway. The important element is that it is on a foreign company. We will start with an assumption of non-listed shares. We will go through all the examples based on non-listed shares. In the end, we will explain what the difference is with listed, if you feel like it. Okay, so Elena, the floor is yours.
Thank you. Cheers to everyone from me. Our first example is the baseline scenario where we are discussing stock options granted by a foreign company, which, as we understand, is often the case. What has been a huge change and has been a constant request from Greek stakeholders, especially involved in tech and startups, was the resolution and somehow clarification as regards the treatment of stock options, which is now clarified, if not entirely, I mean, in clearly most cases. So currently we have a clear framework allowing a capital gains tax treatment of 15% on any benefits obtained by a stock option under the condition that the participant is not selling the relevant shares acquired before the completion of a 2-year period. The 2-year period starts from the grant date. So we have set out, we have presented here a timeline. So let's assume that we have a grant date beginning of 2023. Vesting is not totally irrelevant for tax purposes. What becomes a taxable event is the exercise of the option. At the exercise date, what is important to understand is that, one, the benefit from stock option is crystallized, the taxable event occurs, but this taxable basis is not taxed at that point. Taxation of the employee only occurs at the time of the sale. So there is a deferral up to the time that the relevant share is actually sold. Why is that? In order to be able to determine at that time whether we would qualify for the 15% as discussed, or if sold earlier than in 2 years, we would then fall on the normal rules for employment income, which is the normal scale of up to 44%, which is G's. So at exercise date, so we have crystallized, we have formed the taxable basis, and this is also the time when Social Security will be due. Social Security is not deferred, I'm sorry, but it is something that occurs at that time. So depending on when the employee sells the shares, then the taxation occurs, and he's actually liable for 44% if he sells prior to the 2 years, or to the flat 15% if the sale occurs later than the completion of said period. It goes without saying that any excess will be taxable as normal capital gains, as any shareholder would be taxed at the 15% because he sells his shares.
Okay, so maybe if we go back to the numbers of your example, just to make sure that we are all following the same. 2, 3, and 5 is 2 is assuming the exercise price. Exercise price reduces the taxable capital gain, right? The value to which we refer to define the taxable capital gain that arises upon exercise, so that's July 2023 in our example, before the 2 years, in the example within 6 months, is the net asset value of the share. Now we are on an example where these are shares in a foreign company. So the Greek employee is exercising the option July 2023 and is acquiring for €2 one share in a foreign holding company. And there you have two alternatives, not options, two alternatives to define what the value of that share is. Alternative number 1, you just refer to the accounting books and define net asset value for one share. Alternative number 2, you have a valuation and you refer to that valuation. If you ask a lawyer, the lawyer will say valuation. If you go in the market, two things will happen. If a transaction is happening and a valuation is there, then it's the valuation. If a transaction is not happening, financing is not taking place on that date, then it's net asset value, and that's fine. That is the value on which Social Security contributions will be due on that date, July 2023. That is also the value that the employee will keep aside. And 2 years later, assuming sale, that is the value on which the 15% tax will be due. Correct? Okay. But keep notes. Okay. So this what we're switching here is we are assuming that the program has started running on one company, holding company A, and then before vesting or before the exercise of the option, we have a change of control for whatever happy good reason, and the program is all rolled up to another entity of the new group, the investor or whatever. So we are canceling options and we are replacing them by new options. Okay, so what happens there?
So the interruption on the initial plan, we have a cancellation of vested or unvested options. So at that point, we will not be seeing any taxable events. It is not material from a Greek tax perspective whether vested or unvested options are cancelled. What is important, however, here is that, as anyone would guess, for the new plan, a new 2-year holding period will be initiated. So we need to start counting from scratch, and there is no legal means, at least
not a reliable one.
To include also what the time that has lapsed since the initial plan.
Okay, and the next one. Okay, so now now we're switching the facts a bit, because this is a stock option program that is addressed not only to employees of the Greek company, but also to independent service providing companies like contractors that are set up in Greece, for our example. So you have options granted to a legal entity. Okay, so what happens there?
Yes, so here, in the absence of a straightforward formal employment relationship, what is at risk here would be that Greek gift tax considerations may not be excluded, at least under an aggressive tax audit approach. So therefore, it is important here to note that the evidence of business purpose means why is the foreign company giving at such a low value, giving out such a right to an independent company? What is the link there? What is the business purpose behind that? The more we evidence that, the further we go from a gift rationale and the gift tax considerations.
And then
of course, it should be noted that, as you may see, the company will not be taxed at the 15%, which is the rate applicable to individuals, but it will be taxed under normal corporate income tax rules, and that currently it's 22%, but it could be higher or lower. Of course, in a company context, the taxable base may be different, as the company, of course, may have expenses to deduct, and so the taxable basis may be.
So the effective tax rate could go down to 15. Yeah. Okay. And then. So now all of this is running on a startup, on a Greek startup. And what changes here?
Defined.
Yeah, I think that we should first explain how that is defined. Okay.
Yeah, for the specific provision for stock options, what is the provision? This allows for an even more beneficial tax rate for stock options, the 5%, which is only eligible for options granted by companies, small or very small companies, as these are defined under Greek accounting principles, and granted during the first 5 years of their operations. So it is important that, and of course, and I should note here that registration in Elevate Greece is irrelevant here for this purpose. So there is no, it is explicitly excluded. So we're looking at the size of the entity and how early it was able to grant the relevant options to its employees. As discussed, at the time of the grant, yeah.
At the time of the grant.
And as discussed, what is also different here is that the employees will need to be will need to hold on to their shares and not sell them earlier than in 3 years in order to qualify for the 5% tax.
Okay, so options have to be granted within the first 5 years and have to be held for at least 3. Okay.
Just a small interruption. I have here.
Okay.
So
Okay.
this is open. I think that you know how it works.
To share.
Yes,
Okay.
Sorry.
No problem. Okay. This one we have done.
Yes.
Okay. Sorry.
Still you have.
Still now.
Yeah, now you-
Okay, so we'll just.
Okay.
Okay.
Sorry for this.
No
You
problem.
don't have to.
It's not a problem. Okay, so I'm just thinking out loud. We should first explain the difference for listed and then move to share awards,
Okay.
right? Okay, so the only difference with if all of these examples were running on a listed group, the difference would be that the excess capital gain, so in this example, the additional €2, the excess gain that arises after the exercise and up to the time of sale of the share is fully tax exempt. That's the difference. Okay. Now, share awards. Same rules with one difference. And now you.
Yes. Okay. So no holding period, just this. It's the same treatment. The 15% is applicable again. And here we do not. It is irrelevant whether I sell the next day upon the next day as of grant. So again, the gain is crystallized at the time that I acquired the shares. Of course, in a share, we're discussing share awards. It might be RSUs or whatever else you might see. It's free granting of shares, shares without this prior option legal construct. It's plain shares that you acquire without or with a small, at least at a reduced price. So in this respect, again, at the time of acquisition of shares, we have crystallized the gain, which is only taxable again at the sale. And again, upon acquisition date, there is the social security liability that arises.
Okay.
And also, I should say that this it makes sense for someone to conclude, to deduce that the share award mechanism would be helpful in, say, example 2, where we had to start counting from scratch on the second plan to be implemented. So if the second plan is not a stock option plan, but is actually a share award plan, then it would be irrelevant because the timing would not be relevant for share awards purposes.
And there's also another difference that for share awards, the 5%.
Yes.
5% rate does not apply.
Yes, there is no beneficial treatment for startups here.
Yeah. Okay. So that was all with share awards and stock options. So the overarching topic here is tax efficient compensation for executives. This one is an alternative that presupposes profits. But if it is relevant, then bonus amounts that are paid out of profits to employees who do not hold shares in the company are taxed as dividends, even if they don't hold shares, which means taxed at 5% instead of 44%. Social security contributions apply, yes?
Is this a new law or is it
No.
an arrangement?
No.
And
It
that's
became
not a company.
it became interesting when the tax rate on dividends was reduced. So when dividends were taxed at 15%, it really didn't make
Plus
sense, plus social security,
special
special
solidarity.
solidarity contribution. So that would be 25. Now that dividends are down to 5 and solidarity contribution is no longer in force, it is a very good tool, a very efficient tool,
So long
which
as there are
can
profits.
fluctuate from one year to another. Okay.
Sorry, so that means that the company needs to publish results and then
And-
pay out bonds for the previous year. So it's waiting until June, September of the next year and paying out the bonds then. right?
Yes, or go through the interim dividend procedure and do it twice a year.
Got it, okay.
Okay.
And this is, sorry, is this irrelevant from any subsidies through the R&D, research and development grants, or it is?
So,
isn't it?
Yeah,
It's really
any
kind of-
amounts. Okay, there are two things from the employer perspective. Number one, if you pay a bonus out of profit, it's not an expense. So it does not reduce your taxable profit. That's why we're mentioning the corporate income tax, because if you are fair from both sides, what you should do is you should gross up the amount that you pay out of profits to recover the tax that is not deducted and then pay the 5%. And because it is not a cost, you cannot include it in your R&D tax deductible credit. I'm moving on. Okay.
Mhm.
Now I'm thinking how to bridge. This is also a very tax efficient way of compensating employees who decide to move back into Greece. So it is only relevant for Greek or non-Greek, but definitely not Greek tax resident employees who move back into the country. It's also referred as the brain regain tax incentive. So in cases like your structures, it could make sense when seconding people from branches outside Greece into Greece. So I'll just give it to you to go through how it works.
So the brain regain regime, or 5C, as it is this article in the relevant income tax code, is provides for a 50% income tax break on the persons that move back to Greece. And this income tax break is actually means that they are taxed on 50% of employment income or business income from their activities in Greece. The remaining 50% is exempt, whereas the 50% that is taxed under the normally applicable rules, 9 to 44%. There is also, alongside this tax break, it is important to note that we have also an exemption from deemed income rules as regards the use of any residence or multiple residences and cars. This is an incentive that may last up to 7 years, and persons that are interested in qualified should meet the following requirements. Number one, tax residence outside Greece for the last 5 out of 6 years, and former residents should be from an EU or EEA country or in any cooperative jurisdiction. They need to stay actually in Greece for at least 2 years. They actually do need to solemnly declare their intent to stay in Greece for 2 years. And they should become engaged by a Greek employer, a Greek company, or a Greek branch of a foreign company, or take up business as freelancers or entrepreneurs in Greece.
I think maybe you should waive if you want us to give more or less time on this regime, because this one is only interesting if you have mobility in the people who are working in your companies, or if you have the intention, because that's the only two ways that I can think of how it would work in your case, is the intention to hire people and take the benefit of the tax. So agree on compensation schemes that are effectively taxed at 22 instead of 44, and that can work as a way to bring people back under a Greek employer. I say,
Really, is that like salary income? Because someone could do this and have options.
yes, that's the perfect combination. So you would have a salary that qualifies under this regime and is effectively taxed at 44, plus dividend, plus stock options, which would be taxed at 15. 15 does not become 7.5. Yep. But if it's before the 2-year period, 44 becomes 22. Okay. Okay, so I'll just go then to the next section. I don't see any. Okay. Founders. So we are optimistic and we're discussing about capital gains on exit. From a tax perspective, number one thing, again, we are discussing Greek tax resident founders, irrespective of whether the target is in the underlying company is in Greece or outside Greece. A Greek tax resident founder is subject to 15% tax on capital gains generated upon exit and 5% in case of dividends. I would assume that capital gains are more relevant in our discussion. And that is the same irrespective of whether, I repeat, the underlying company is in Greece or outside Greece. Now, in the event that a holding company is interposed between the founder individual and the underlying operating company or group of companies, the good news is that the tax treatment is reduced. The reason that it is reduced is that because effectively all capital gain is converted into a dividend. It is a profit of the interposed holding company that is distributed to the founder. So 15 is reduced to 5. On the other hand, we are in the zone of kind of aggressive tax planning, which means that anti-abuse rules come into play, and that makes the structure more complicated. Can be done, but it is more complicated, which means that it makes sense when you have a heavier structure. Heavier meaning more mature. In between those two alternatives, there is also the alternative of a Greek holding company. So you have an operating company or group of operating companies in Greece or wherever within the EU, wherever within the EU. You have a Greek tax resident founder, and between the two levels, you could have a Greek holding company. That would allow converting the capital gain into a dividend. So 15 would be effectively reduced to 5. This is under the assumption that that holding company does not exit within less than 2 years. There's again a 2-year minimum holding period requirement. The good thing with the Greek holding company is that it is not aggressive tax planning, so anti-abuse rules do not apply, are not triggered, they are not relevant. And this is, yeah.
Very quick question, because you say EU, so that does include UK, correct?
Yes, no.
But it was correct.
The UK would be included in this program.
You would need to interpose an EU, so it could be one more layer. Okay. Okay, so I think I explained that. And just clarifying that this is a vehicle that can be interposed in a structure either in the beginning or as the investment matures, meaning we have seen it is quite common that founders would start with a non-Greek holding company and at some point interpose a Greek one, which can be done in a tax neutral manner. Okay, now this is structuring of business operations, so maybe you want to explain what that is.
Yeah. So moving on to a different matter here, what we wanted to briefly touch upon with this audience is what we find a very interesting and attractive regime in Greece, the so-called cost-plus regime, which is applicable to, it's mainly intended at ensuring tax certainty for shared service centers. What do we mean? Tax certainty means that the relevant companies, it may be a company or a branch of a foreign company, it's no different. So the relevant entities may qualify for a relevant license under the Ministry of Investments in order to be able to obtain a pre-approved profit margin for at least 5 years. This margin means that essentially all expenses of the relevant company will be treated as tax deductible so long as the company complies with its obligations. What would be the obligations? It would be for it to be providing specific services
Which includes
software development or a call center or data management. There are several services listed specifically in the relevant law, and the relevant company is precluded from performing any other activity. The relevant services are only to be provided to affiliated entities. So the aim here is to create a service hub in Greece with certain employees. There should be at least 4 at all times, and a certain level of expenditure, at least 100,000 euro per year, in order to be able to maintain this pre-approved margin and tax certainty. What is also important here is an additional element of tax interest, of a tax, I wouldn't call it benefit, but again, in the area of certainty, is the fact that when a company operates under this regime, it should be protected from being considered as essentially managing the company, the recipient of the service. That is why we say that, because it might be the case that we have a hub here and there are certain functions that are performed that fall within the scope, but might, under a tax audit approach that may be not considering all facts and circumstances, be considered as bringing some part of management in Greece, which should, under normal circumstances, make the foreign company taxable in Greece. In our case, when we have a company under Law 99, this would be shielded from being considered as effectively managing the recipient, the affiliated company that exists, that is established abroad.
So if we just, I'm just again putting this into your reality, I think. If the software developers are in Greece and the clients are outside Greece, then the entity that is employing the software developers in Greece could qualify under this regime, assuming 100,000 euro, assuming 4 employees. That entity would be providing services to the foreign one that is selling. And because it would be operating under this regime, it would be protected from all those tax risks as to where the profit from sale should be taxed. I see a hand.
So your clients can also be in Greece, but your invoicing company has to be in Cyprus or another country. You can still have clients in Greece, even if you have an 89 regime in Greece.
Okay.
But you have to invoice from somewhere else.
The local employees, because the critical thing is who does what. employees who are in Greece and are in the hub, that is the law 89 cost plus service company, are not selling.
Yeah, I know that.
Okay,
So that's why they say you
So-
have to invoice it from another country or another
So,
entity.
I'm just legally speaking, jargon, not just invoice. You are selling from the foreign company.
yeah.
Your sellers are at the foreign, salespeople are at the foreign. The software developers are here. And what that regime gives you is that I don't ask who is
I
selling.
think technically you can also have consultants and marketing in 89 law.
Exactly,
So you can initiate the sale, but you cannot actually close it. So I guess.
Exactly.
Pretty close.
exactly. And I can take questions on that after recording this. Thank you. Okay.
So yeah,
Yeah.
just noting here that this is because we only said the bright side. There are some restrictions, of course. This is a license granted by a ministry. There is annual reporting. There are some delays in obtaining the license, and there is, of course, the restriction on business activity. As discussed, we may not perform anything else other than the service that we are licensed to provide.
Okay.
Okay.
Last section, last slide.
Yeah.
Yours.
And so to wrap up what we discussed earlier, we are just putting again, just reminding the tax benefit that is applicable for, it's been 3 years now for angel investors, meaning individuals who are investing or contributing, essentially participating in share capital increases in newly in startups that are registered under Elevate Greece. Those individuals, be it Greek or foreign tax residents, they are eligible for a 50% reduction of taxable income of Greek income that is taxable in Greece, and only up to a certain threshold, meaning that they may only get up to 150,000 euro per year. I mean, in total
Of a deduction.
of a deduction. This means in legal jargon, again, I would say that you may not qualify for a deduction further than 2-3 companies of 100,000 each, but essentially these are details. What is important to note here is that the relevant individuals should be obtaining a Greek tax ID number in order to qualify, and that the relevant contributions will need to be made in cash, currently to a Greek bank account of the recipient. We suppose that this might be altered. This is an interpretative decision that has been issued at the time that the relevant incentive was introduced. So yeah,
Okay.
this is pretty straightforward.
So I just, the only thing I'm clarifying here, because I didn't know it and Elena explained it, is that this is a deduction on taxable income, not on tax to be paid, which makes it, yeah. Because, well, an investor might have tax exempt income, so it's not a credit against the future. It reduces the taxable income of the year.
It's actually beneficiary for potential investors that are based on salaries, because it reduces the 44%. If you are
Yes, so it's
If
an
you have a lot of
individual
dividends-
earning salary income. Yeah. Yes,
because the
you're right.
person told me my income is from dividends, so I don't pay a lot. The company pays the tax. I said, okay, but yes, the main beneficiary person, the person that the majority of their income is from salary,
Yes,
assuming that they are on top of the 44%.
Yes.
There are many investors that have that.
yeah.
That's why they did it.
Can you repeat maybe for the video?
Sure.
I'd like us to ask, like, we can keep going afterwards, but we can ask like maybe 5 basic questions, but you can maybe repeat for the video what we're asking.
Okay, Sure.
So it makes sense in the answer. You can start, Elena, if you want.
I have a lot of questions.
Yeah.
First one is here. It's a minor. It has to do with the restriction, let's put it that way, that the company in which you have to invest in should be in Elevate Greece. But most of our companies here have their Greek subsidiaries in Elevate Greece, while the capital, the increase in capital happens in the UK or in Sweden or wherever else,
Yes.
or in the US, wherever. Is this applicable?
No. Let me repeat the question. So this is, or said another way, this is only applicable for contributions for cash that is paid directly into
I
the.
have a UK entities account here in Greece. It's fine.
No.
We can.
Paid directly into the equity of the Greek company. It has to finance the Greek company.
Yeah, tax authorities ask for the certificate from GEMI.
Yes,
Yeah.
they have to
Yeah,
see.
yeah.
So it's only share capital increase and only of the Greek company.
So to build on her question, could one do it if the company was willing to structure the funding via the subsidiary, basically? Because a lot of Greek companies have mothercore in the UK, for example, but they have a subsidiary in Greece.
Mm.
So in these cases,
So you
if
mean
the
that-
company is willing to structure the funding on the subsidiary level, or that's the only way to do it.
But you would smear the Greek entities.
It would damper.
Yes, and then you would have to go through an upstream loan. So you would have, yeah, you could from a tax perspective, but
That doesn't
you
make
wouldn't.
sense.
Yes.
Okay.
Should we go from the beginning? If possible?
Sure. One more time.
Yeah, I have one slide. Mine is very straightforward, I think. So I understand that in cases of accelerated testing, so when there's an event and an employee, vests all their options immediately, if it's less than 10 years from the time, well, obviously they have not even exercised it. So obviously they don't take advantage of the 15% then.
Again,
So
when were the options granted in your example?
So my question is, the 2 years time
Mhm.
counts from the grant date or from the exercise?
Okay, so the 2 years time counts from the grant date. It's grant date to sale.
So if it was awarded two years ago, like 3 years ago, or something, then you do qualify for the, even
Yes.
though you have not exercised them,
Correct.
because you have not exercised. them,
Correct.
right?
Yeah. So the critical event, 2 critical events, granting, sale of the share for the 2-year period.
Okay.
Okay.
And one more question, which has to do with valuation.
Mhm.
It's a bit more tricky maybe. On the exercise date, assuming this case that I'm referring to, so there's an event, and everyone wants to exercise T-1 before the event.
Mhm.
What's the exercise price that they can claim, given that there's a valuation event like so shortly after, like immediately after the exercise?
Like the exercise price is from stock option, it's like a fixed number, isn't it?
You mean the value of what we refer to as the net asset value on the exercise date? Okay. So what we have in the law, lawyers respond based on the law, and then I will tell you what happens in practice. On the law, it says market value. There's a guidance from the Ministry of Finance. It says accounting net asset value of the share. That means look at the accounting, look at the balance sheet, divide. No reference, no reference, no reference. So the guidance says look at the accounting net asset value. Then you have other types of guidelines that are not referring to stock options, but do refer to how you evaluate shares. They would say last month trial balance sheet, based on that, net asset value. So the safe guidance is last month trial balance sheet. But because the law says market value, if there is reliable evidence that market value at that time is something else, that's why I said if if you are very close to an event and there's a valuation that's very close to exercise, it's safer to go with a valuation. Otherwise, it is highly unlikely that the tax authority can overturn a valuation, a definition of taxable value that is based on your accounting books.
But does it really make a difference since you're supposed to sell them a couple of days later, T+1?
Exactly,
So
you're
it's
right.
the same tax
It really does. Only for the social security contributions.
Okay, yeah, correct.
Only for that.
This is not the tax authority, this is EFCA.
Correct.
And that's my question, EFCA. We owe, the social security contributions are owed both from employee and employer, right?
Mhm.
And at the end of the day, so usually, at least how we have it here, we never actually pay the exercise or the exercise monies. So if you exercise on July and then you have a sale on in a year's time, the exercise payment is deducted from the proceeds. So it's deducted from the net asset value. So the company at the exercise date should pay both employee and employer. In reality, in practice, even EFCA, do they have the proper code to pay this exercise social security? I doubt if they do. They have the code, they have how to
You
declare
would,
it.
No, well, there is no clear guidance from EFCA in this respect, but the safest way is to approach this upon the acquisition, because in principle, whatever is received by an employee is a benefit in kind and
So
is
you
thus subject to social security at the time of acquisition. So anything else should be explicitly provided, and to the extent that there is nothing provided to date, we are going with the most conservative approach. Of course, there are some compliance is pretty straightforward. I mean, in our experience, it is performed at that point. But guidance, no, there is not any.
it is what I have understood from compliance on this is that this is treated as a benefit in kind in the same way as a car, as a phone. Same thing.
Has any of the companies that you have advised paid that?
That we will not respond to.
No,
I can
want
tell you
the
that
practice, that's why I'm asking.
I can tell you
might
that
not have an actual case.
the problem with it, as you obviously, I mean, we all see it, is that this is happening at a time where no liquid event is happening. So it's an extra cost, and it could be a cost for the employer. It could also be a cost for the employee, which is really strange. And then you really have to go case by case and see.
How is it possible to be asked from an employer to pay contribution without having any gain?
Because the benefit in kind, which is the value of the share, you're on exercise. You have exercised. The employee has exercised. So the benefit is there.
I have another question. So let's say you have, maybe it's more about the share awards. Let's say you have an upcoming sale and you have some employees that you have not granted options to in time. Okay, what do you do?
You grant share awards.
You grant share awards. And isn't there, again, why don't we all then just grant share awards? What's negative about them? Because they seem like ideal, other than the fact that you cannot spend the 5%, they seem perfect, no.
From a tax perspective, and we have really, yes, dig deep on this, there is no difference. Actually, from a tax perspective, share awards are much nicer, much simpler, much more straightforward, save for the 5% benefit for startups. From an accounting perspective, my understanding is, and I repeat that we are lawyers, that share awards are reflected in the company's equity in a different way makes it heavier, if I understand correctly, than an option. And that is why usually groups that are growing prefer options. So but it's accounting. Okay.
So you could T-1 issue a
Yes,
share
you could.
award for free, practically.
Yes, it's exactly the same. The other difference, other than accounting, could be legal, and that is also something on which we fall. It's an obstacle. When you're granting shares, then depending on in which country you're doing the whole thing, you have to provide for restrictions, for the shares not to have voting rights, for the shares not to be transferable. It is heavier in documentation as opposed to an option that you can do nothing with. Okay.
Regarding evaluations, what are acceptable valuations? For example, is Pro 9A acceptable? And also, how recent does it have to be? Because a lot of companies also obtain Pro 9A valuation valid for 1 year in the US. Can that also be used for good purposes?
So again, I'm going back to the response that there is no official guidance. And again, from a practical perspective, it is very hard for a tax authority to overturn a valuation that an employer is bringing forward. It is not hard for the tax authority to define a taxable value if you have defined zero by just referring to the financial statements. But if you are referring to a valuation that is reliable for US purposes and it is not more than 1 year old, you're fine. Now, if at the same date or at the same period, you're also having a new round or an exit event with a valuation that is significantly different, then the problem is that the basic term, the fallback for all of this discussion is market value. We are looking for the market value. So if within 1 year you have a reliable but very low valuation and the valuation on the basis of which a transaction is taking place, you would go with the second. Okay.
Can you change the grant date to whatever date you want, or is it something that's listed anywhere? So
Grant date is in the program, so we are in a non-listed environment. Okay, so you have a program that the employees sign, saying that today we are.
Sorry.
Yes.
You can. It's an
To
internal
backdate.
agreement.
I'm not sure because there's a corporate resolution. Yes,
It
because
requires publicity from the-
exactly.
I don't know.
If it is, if it,
No,
No, no.
the plan itself.
In a Greek holdco, not in a foreign
For
holdco.
a Greek, I don't know, for a Greek.
In a foreign
publicity.
holdco.
you're right. If the program, but I would assume, like if the foreign company is a UK company, there is a corporate resolution that is reached on the date that the options are granted.
The board has to sign it normally.
Well, in Greece, it is a general meeting of shareholders, isn't it? In the UK, I am not sure. So what you have to see if is that published? Is that decision published?
Okay, no, there is. I mean,
Yeah.
for our
But if you were to go down that road, you will be going down the road of share awards, which is much simpler.
Just to gain the 5%. In my experience, the board always approves the stock options before they're granted. And although the board is willing to, cut terms to benefit employees, for some reason, I've never seen it happen, although we happily grant it. So there must be some sort of obstacle.
they go with awards.
Yeah, we go with awards in the good cases. Yeah, we go with awards and you benefit from the 15% and not the 5%. I mean, my reading of all this is that it's better for the founders to give out options, awards, whatever.
Early on.
Sooner rather than later. That's what I understand. What I
Yes.
not hold off on actually doing the maybe boring part of the work and actually avoiding the issue.
Yes, that is correct.
Elena, sorry, minor question here regarding the social security, assuming the exercise price or the stock option is at half the net asset value, which means that actually the employee is buying things without a benefit.
No social security
No
contribution
social
due.
security, yeah, but is there a declaration of some sort, just to log it, to the EFTA, look, we're doing the transaction at zero benefit to the employee?
I'm not sure. I'm not sure. But even if it were, I mean, if you're reporting zero as the value of the benefit, even if it, I wouldn't even go through it. No.
So how can you do that?
A benefit of zero. Not sure. I'm not sure if it is possible to because that's it's not like a loss that you can use in the future.
This was the exercise date. Okay. Reported on the exercise date that there's zero benefit to the employee.
Okay.
They're waiting for the sale date to
Yes.
report the.
Yes, but you can lock it through your transactional documents. It's not the EFCA thing. It does not work. It is not. It's like two separate things: social security contribution and taxes. One does not help the other.
Another question that I have, given the complex structures of foreign holdco, can the state of the other country, their tax authorities, think that you are liable for social security contribution in their country, or since the employee is based here, they cannot have any claim, or can they have some?
No. The social security contributions have to do with where the employer is. So it's not a matter, it's not Greek tax resident employee, it's employed by the Greek company.
A Greek PIN number, let's say.
End of discussion for
So
social
end of
security
discussion,
contribution. Yes.
Even if there's a holdco in the US or in the UK,
Yes.
the US cannot be asking for any taxes to be paid on that.
Social security contributions, not taxes.
So taxes, I mean, from the company side. Is the company
Taxes will be paid. Out of scope of our advice, but taxes in the US in specific, when the time comes to exercise the option for a Greek tax resident, Greek employee of the Greek subsidiary, options and shares on the US entity, there are taxes payable in the US, but that's US tax.
By whom? By the company? Or
By-
the employee?
By the employee.
So the company cannot be liable for
No.
anything more
You're right.
other than the country where the employee is employed.
Yes.
But there could be claims made to the employee.
It's
by-
withheld. It would be withheld through the depository. The amount that will come down to the account of the employee will be reduced by the US taxes.
Yeah, sorry, another question. Now, is it worth lobbying now EFTA to push this social security like we did for the tax, or do you think it's a lost case? It's a lost cause. We won't have the same leverage as we did with.
Let's do it after the recording. Okay.
Okay, I have one more. If I understood correctly, the contractors, I was under the impression that English contractors, after the change in the regime, that contractors were treated as employees in terms of options.
Yes, but that is if they are acting as freelancers, not
Yes.
in our example, they have set up a company. So they have set up an IKE, their own IKE, and the IKE is the one that is charging.
Okay.
If they are contractors who are acting as freelancers, then yes, they are treated as employees if they don't have more than 3.
And they fall in the previous.
And then they
category.
fall, yes, they have the same treatment.
The blockade. No, I'm covered.
Okay.
Just another note, but usually, for good governance reasons, we don't allow founders, especially in the early stage, to sort of optimize for tasks. tax and have like different entities, like you mentioned, like having an entity through which they get paid or they receive their share awards. That's not something that's really recommended for the early stage startups. We want just the simplicity of the structure. It also introduces several risks for the investor because they have to be also on top of another entity and see that these entities' compliance makes sense. It's something that maybe can be done in a later stage, and or when the time comes. We have like no reason to stop the founder from getting beneficial treatment, but usually we are reluctant to accept such a structure
in the beginning.
But is there something that we should think in the beginning that doesn't change later?
Okay. Wait, sorry. So let's instead of the gray picture, instead of referring to Greek or EU sub, let's just say that that's the operating company. So you start with a structure where the Greek founder directly holds the shares in the gray entity. And then at some point, you need a legal entity, not for tax purposes, but for example, because they are all moving one step up because financing or an investor comes and then they are all holding through a common vehicle where everyone has to contribute the shares because that's the entity on which the shareholders agreement is running. At that point, that Greek tax resident is transferring the shares. Contributing in Greece means transfer. Contribute for some reason in taxes means sale. So when the shares from the Greek entity are contributed into that holding entity, a capital gain arises. Now, there are a number of ways to neutralize the tax treatment of that. There are latest. So yes, you can go into the structure later and not in the beginning. But the later you do it, the higher the capital gain that arises at that time, at the time when you interpose the legal entity. And that could be a taxable event, which happens at the time when, again, it's an illiquid taxable event. That could be the problem. Okay. That's it.
Yeah, thanks a lot. I think we can stop the recording.
Okay.
Thanks a lot.
Thank you.